The coronavirus pandemic has wreaked havoc on Wall Street. The daily market swings have been steep and sudden, and the violent moves downward have triggered a series of countermeasures intended to keep the stock market from collapsing. Safeguards like trading halts, circuit breakers, and limit up and limit down mechanisms.
The market-wide circuit breakers are designed to slow trading down for a few minutes to give investors the ability to understand what's happening in the market, consume the information, and make decisions based on market conditions. It's a plan that's put in place for situations like this. It's been tested. We test it every quarter, so this is operating as it's supposed to.
After the Black Monday stock market crash in 1987, the SEC instituted stock market circuit breakers designed to stop trading if the market dropped precipitously. The measures were adopted in October 1988 and weren't triggered until 1997. But during the ongoing coronavirus pandemic in early 2020, they've been triggered several times. The S&P declined more than 8% on March 16, 2020, almost immediately, due to fears over the coronavirus and its impact on the economy. The drop occurred a day after the Fed announced several extreme measures to stimulate the economy. As a result of the collapse, a circuit breaker was triggered and trading was halted. Trading resumed after the break, and the Dow eventually ended the day down nearly 3,000 points. That particular circuit breaker was a level 1 halt. A level 1 happens after a 7% drop and stops trading for 15 minutes, as long as it occurs before 3:25 p.m. After 3:25, there can be no trading halt unless the market drops by 20%. A level 2 halt occurs after a 13% drop. On a level 2, trading is also stopped for 15 minutes and continues afterward, unless there's a level 3 halt. A level 3 halt occurs after a 20% drop and can occur at any time during the day. During a level 3 halt, trading is suspended for the rest of the day. In 2012, the rules were amended to address more modern electronic markets. The new initiatives made the S&P 500 the benchmark index instead of the Dow Jones Industrial Average and lowered the drop necessary to trigger a halt. They also added something called a limit up, limit down mechanism. Limit up, limit down mechanisms stop trades in the futures market and happen during non-regular trading hours. Stock futures are halted if they hit an upside or downside limit of 5%. Essentially, the futures get pinned at the 5% limit and cannot trade above or below the upper or lower bound, respectively. This helps ensure an orderly and non-emotional opening trade session.